Here's a number that should bother you: $72,000. That's how much you're allowed to put into your 401k this year. The IRS sets a total annual limit on all contributions combined, your deferrals, your employer's match, everything. In 2026, that ceiling is $72,000. But most people stop at $24,500. That's the standard elective deferral limit. They max out their pre-tax or Roth contributions, pat themselves on the back, and move on. And in doing so, they leave nearly $50,000 of tax-advantaged space on the table every single year. There's a completely legal way to use that gap. It's called the Mega Backdoor Roth, and if your 401k plan supports it, it's one of the most powerful retirement tools in the entire tax code. Let's start with the basics. Your 401k actually has 3 buckets, not 2. Most people know about the pre-tax bucket. Money goes in before taxes, grows tax deferred, and you pay income tax when you withdraw it in retirement. Then there's the Roth bucket. You pay taxes now, but the money grows and comes out completely tax-free. Those are the 2 everyone talks about. But there's a third bucket that most plans offer but almost nobody uses, the after-tax bucket. This is not the same as Roth. After-tax contributions go in with money you've already paid income tax on, just like a Roth. But unlike Roth, the earnings on after-tax money grow tax-deferred, not tax-free. So if you leave after-tax money sitting in the account for years, the growth gets taxed as ordinary income when you withdraw it. That's not great. But here's the trick: if you convert that after-tax money into a Roth account quickly, before the earnings pile up, the entire amount becomes tax-free forever. That's the Mega Backdoor Roth. Here's how the math works. The IRS says total additions to your 401k in 2026 cannot exceed $72,000. That's the absolute ceiling. Your standard elective deferral, the money you choose to put in from your paycheck, is capped at $24,500. Your employer's match counts toward the $72,000 too. Let's say your employer puts in $10,000. That leaves $72,000 minus $24,500 minus $10,000, which equals $37,500 of available after-tax contribution room. That's $37,500 per year that you can contribute in after-tax money and then convert to Roth. Do that for 20 years at a 7% average annual return, and you're looking at roughly $1.5 million of additional tax-free retirement money. And that's not counting the standard $24,500 you're already contributing. Now, the Mega Backdoor Roth has a few requirements. First, your 401k plan must allow after-tax contributions. Not all plans do. Roughly 30% of plans offer this feature, and it's more common at larger companies. Second, your plan must allow either in-plan Roth conversions or in-service withdrawals to a Roth IRA. An in-plan Roth conversion keeps the money inside your 401k but moves it from the after-tax bucket to the Roth bucket. An in-service withdrawal lets you roll the after-tax money out of the 401k and into your own Roth IRA. Either works. The key is that you need both features, the ability to make after-tax contributions and a path to convert them to Roth. If your plan has one but not the other, the strategy doesn't work. One of the most common questions people ask is whether the Mega Backdoor Roth triggers the pro-rata rule. The pro-rata rule is what makes the regular Backdoor Roth IRA complicated. It aggregates all your traditional IRA balances and taxes conversions proportionally. But here's the good news: the pro-rata rule does not apply to 401k after-tax contributions. The IRS treats 401k money separately from IRA money for this purpose. So even if you have a large traditional IRA balance, you can still do the Mega Backdoor Roth without any pro-rata complications. That's a significant advantage over the standard Backdoor Roth IRA strategy. Timing matters with the Mega Backdoor Roth. The whole point is to convert the after-tax money to Roth before earnings accumulate. If you contribute after-tax dollars and they sit in the account for months or years, the investment earnings on those contributions will be taxable when you eventually convert them. The solution is to convert frequently, ideally every time you contribute, or at least every pay period. Many plans allow automatic in-plan Roth conversions, so the after-tax money moves to Roth almost instantly. If your plan doesn't offer automatic conversions, set a calendar reminder to do a manual conversion every month or every quarter. The less time the money spends in the after-tax bucket, the less earnings accumulate, and the more of your conversion stays tax-free. There's an important connection to Secure 2.0 that makes the Mega Backdoor Roth even more relevant in 2026. Starting this year, if you're age 50 or older and earned more than $150,000 in FICA wages the previous year, your catch-up contributions must go into a Roth account. You can no longer make pre-tax catch-up contributions. This means high-earning older workers are being pushed toward Roth savings anyway. The Mega Backdoor Roth complements this perfectly. It gives you an additional channel for Roth savings beyond the standard deferral and catch-up limits. For someone in their 50s or early 60s who's behind on retirement savings, combining the super catch-up of $11,250 with the Mega Backdoor Roth's after-tax room can add $50,000 or more in annual Roth capacity. Let's talk about who benefits most from this strategy. The Mega Backdoor Roth is ideal for high earners who have already maxed out their standard $24,500 $401,000 deferral and their $7,000 Roth IRA. If you're in the 24% tax bracket or higher and you have extra savings capacity beyond those limits, the Mega Backdoor Roth is probably the best place to put that money. The alternative is a taxable brokerage account, where you pay taxes on dividends every year and capital gains when you sell. The Mega Backdoor Roth eliminates both of those tax drags. Over a 20 or 30-year time horizon, the difference between tax-free growth in a Roth and taxable growth in a brokerage account is enormous, often hundreds of thousands of dollars. There are a few traps to watch out for. First, not all employers offer after-tax contributions, and even among those that do, the available room depends on how much your employer contributes. If your employer puts in $15,000, your after-tax room shrinks to $32,500. Second, some plans limit after-tax contributions to a percentage of your salary rather than the full IRS limit. Third, if you change jobs, make sure to convert or roll over any after-tax money before leaving. It's easier to manage inside the plan. And fourth, remember that the $72,000 limit is per person, not per household. If both you and your spouse have 401k plans that support the Mega Backdoor, you can each contribute up to the full limit. Here's a practical action plan. Step 1. Log into your 401k account and check whether your plan allows after-tax contributions. Look for a section called After-Tax or Voluntary After-Tax in the contribution options. Step 2. Check whether your plan allows in-plan Roth conversions or in-service withdrawals to a Roth IRA. This is usually in the plan document, or you can call your benefits department. Step 3. If both features are available, set up after-tax contributions up to the available room, the $72,000 total minus your standard deferral minus your employer's match. Step 4. Set up automatic in-plan Roth conversions if available, or schedule manual conversions every pay period. Step 5. Track your total contributions to make sure you don't exceed the $72,000 limit. That's your responsibility, not your employer's. The Mega Backdoor Roth isn't a loophole in a sneaky sense. It's a feature that Congress intentionally created when it designed the 401k contribution limits. The $72,000 ceiling exists to allow generous employer contributions and employee savings in the same plan. The after-tax conversion mechanism exists because the IRS decided that money you've already paid tax on shouldn't be taxed again. Put those two features together, and you get a strategy that lets high-saving individuals put tens of thousands of additional dollars into tax-free retirement accounts every year. If your plan supports it, you have access to one of the most powerful retirement savings tools in the tax code. The question isn't whether the Mega Backdoor works, it's whether you're leaving $50,000 of tax-free growth on the table every single year. That's financial literacy, not luck.